Welcome to Changing World, New Opportunities. This podcast is brought to you by the DC Investment Forum and hosted by me, Louise Farrand, and my co-host, Dave Whitehair.
This season, we're talking to the UK's leading master trusts. Millions of members and people in the UK now rely on master trusts for the future of their retirement finances. And we were interested to know how master trusts are investing and what the future holds.
In an uncertain world, how are they managing risk? And what's next on their agendas?
The DCIF's mission as a whole is to shine a spotlight on topical DC investment issues. And you can learn more about our research, follow us on LinkedIn, and subscribe to the show at dcif.co.uk.
Welcome to Changing World, New Opportunities, Season 4. I'm here with my co-host Dave and with James Lawrence. Hi, James.
Hi, thanks for having me.
Nice to have you with us. James, you are Director of Investment Proposition at Smart Pension. Thank you so much for joining us. You've been at Smart for just over 4 years, I think. And before that, you were Lead Investment Strategist in Mercer's Workplace Savings business, I believe. And you've obviously been on this podcast before.
Yeah.
I mean, it was a really good chat. I definitely remember we had some technical problems.
Not today.
Hopefully not today. Thankfully, not in my hands today, which is a bit of a relief.
But looking forward to having a conversation. Obviously, I classify Smart as one of the disruptors in the UK master trust market, a technology-led business that's placed investment at the centre of its proposition. You've had a lot of really exciting announcements recently we've seen in the industry press. So looking forward to diving into some of that now.
Definitely.
Yeah. So tell us a bit about where you are investment-wise today. I mean, I know we spoke about it 2 years ago, but for anyone who didn't listen to that, give us a bit of a refresher on where you're at a kind of helicopter view sort of level.
Yeah, a lot changes in 2 years as well.
Really?
Both for us and the industry. I think lots going to change in the next 2 years as well. It's a really interesting time to be here.
Yeah.
We've done a lot. I think one of the biggest things we've done is put in synthetic equities, and I'm looking at Dave here as an active management house and thinking, is he going to let me talk about synthetic equities? But we're doing it so we can we've done it so we can get headroom for private markets and active investment and all sorts of weird and wonderful stuff that's going to give us great returns. So that's probably the biggest thing we've done with that. So that's a brand new product that we've launched, about £3 billion in that now. We've also announced 15% to private markets. I'm sure we'll come on to talk about Mansion House and the world in Mansion House land, but we've announced that. We've just started putting money into our new strategy as well. So that's infrastructure and private equity to add to the private credit we've got.
Amazing.
A lot. They're probably the two biggest things. But I mean, we continue to grow quickly. We're at nearly £8 billion now, going to be 10 billion within the next 6 months. So rapidly growing, which is always nice.
Idiot's Guide to Synthetic Equity.
So it's we've built our own custom index, custom benchmark that we also have a standard physical fund tracking as well. So we've kind of got both versions. Yeah. But it's effectively a swap. So we have a swap that gives us the return of that, but it's it's effectively zero cost because it's built into the swap. So it's better for members because they have better returns than just the passive equity, and it's better for members as well because we can use that money to put elsewhere into more expensive stuff. So
can you just remind us and the listeners around the viewers as well watching video this time, what your glide path journey is at a high level? When do you start de-risking, into what sorts of assets? Very interesting to know. Yeah,
so we're fairly traditional. We have an 8-year glide path. We have a growth fund for the majority of that, so it's 80% equities. Well, at the moment, so it's 75% equities, 15% private markets, and 10% into active bonds, and then that glides over 8 years. We glide into our 4-pot model effectively for retirement. So it's both the kind of traditional de-risking into more defensive asset classes, but it's also moving members into what we think they're going to do in retirement as well. So de-risking them from what they actually are going to hopefully be on the journey with us for the next 20, 30 years through retirement as well. Yeah. So we're fairly late in terms of de-risking. We think we don't want to start de-risking too early because there's just no point, it's not cliff edge anymore. This is another 30 years they're going to be invested with us for. So let's de-risk late and let's keep them through retirement. Yeah.
Okay. And in terms of risk management, I mean, we've talked about this quite a bit recently. There's never a calm period in investment markets.
No.
There's certainly been choppy recently, both kind of geopolitically, macroeconomically. We're in a kind of new interest rate inflationary environment. How have you evolved your investment governance model at Smart to cope with some of this? And have you allocated new resource? Have you worked with more advisors? What's happening in this space?
Yeah, a bit of everything. I think we're lucky to have quite a good base already with a really interesting trustee board. They're not your usual trustee board. We've got people that are management consultants and people that are more traditional CIOs and others that kind of really impact lens focused and all sorts of things. So we've got quite a good mix of people, and they bring really interesting governance and calm everything down, I think, during these periods as well, which is really helpful. That being said, we've added resource to our team internally. We're still only a team of 3, so we're quite a small team managing quite a lot of money. Which is because we're lean in a tech firm. That's kind of how we want to run. We want to be quite agile, but we rely and we use a lot of external advisors, managers, partners. So we work quite heavily with some of the big investment managers in the world to get their thinking on this stuff. But I mean, generally we try not to panic, and we're trying to put that message forward to our members as well. We still stick with a long-term investment thesis. We obviously have some pretty frank, brutal conversations at these kind of investment committee meetings around the dollar, for example, and where the US is going and what Trump's going to do and whether we should do anything. But we generally come back to let's trust our governance and let's not make anything rash, any rash decisions.
How are you thinking about diversification in today's market?
Yeah, it's a really interesting one. I don't think, 10, 20 years ago, diversification is pretty simple, right? You just do 60-40 or 70-30 and you just get some different sectors. And now you just have to think about political diversification. You have to think about climate diversification. You have to think about all these different things. So we obviously think about it in the traditional way of diversifying asset classes and managers and sectors and geographies, et cetera, et cetera. But a real key thing for us is thinking about a lot of the idiosyncratic risks that are in this world these days, the political diversification, the climate diversification that I mentioned as well. And then the other angle to this is the member side of things, is how do they react to this diversification? Because it's all well and good saying we've got this amazing technical investment diversification, but if it's not what they're looking for and it's still not giving them the returns that they are expecting, then we've really got to think about if the diversification is the right type. So it's a really complex prism at the moment to really manage and think about that one.
Yeah, that's really interesting.
You've obviously alluded to focusing on the long term and trying to avoid short term noise of your advisors and things. But how do you frame kind of the long term? What sort of time horizons are you thinking about, and what are your objectives long term with the investment strategy?
Yeah, I mean, generally long-term inflation plus 3.5 is where we want to be and where we've been over the 5 years, which has not been particularly easy given where inflation's been. Yeah. So we're pretty happy with that performance. But I mean, look, 20, 30 years is got to be the horizon for us. We're not, being silly enough that we won't make changes within that time period, because the world changes and we need to think long-term at all time periods. But we just have to think kind of 30, 40 years for these types of people. That's particularly coming to the fore with retirement now as well. I think a lot of pension schemes have been able to think long-term for their growth funds and accumulation side of things, but haven't really been able to do it longer term for post-retirement because people leave, the architecture's not there, the solutions aren't there. Yeah. People do all sorts of weird and wonderful things in retirement, but now actually we can start to see members staying with us for kind of 10, 20 years and laying the groundwork for being with us for those periods. So we have to respond to that and build solutions for that as well. So yeah, it's starting to be long-term, but truly long-term.
Have you got volume coming through into the kind of accumulation phase yet, or are we still a number of years away from?
We've got some, if I'm being honest. It's probably not as much as we hoped or anticipated. We've got quite a good solution, but we probably need to build on that and just make it a lot more captive for individuals. Right. What we see is a lot of people transferring out to SJP or an AJ Bell or someone because this is an incredibly complex world. They've got pots all over the place. I've got my father-in-law retired recently. He's probably exactly the type of member that we target and lots of providers target, kind of mid pot size, 5 different pots, doesn't have a clue what to do with it, and actually ends up kind of going with an advisor. Luckily, the advisor's my friend, so I put him in the right place, I think. But, it's not, it's one of those things where there's still such a massive gap between what pension schemes can offer and what people actually want. And closing that gap is tricky. Yeah. Pension schemes are quite averse to doing the things needed to fill that gap. Yeah. We're obviously trying, as lots of others are. There's only so much we can do through neat investments, if I'm being honest. There's only so much we can do through a lovely user journey, but it helps. But it's really about supporting them and just giving them every single kind of thing they need on that journey.
Yeah. I feel like it's all about the user journey, really. And making it clear and easy for people and kind of signposting.
Yeah.
things properly. I guess as a tech firm, do you feel in a good place with that?
We do. We think about ourselves, of like the Monzos of the world, the way they've disrupted banking. We think we're disrupting pensions in the same way, but we need to do that through retirement as well. We have we think we've got quite a nice journey through retirement. We did a lot of research.
Yeah.
We have people that are not pensions people, and they do lots of user research that's just based on like Spotify's of the world and Monzos of the world and all that kind of non-pensions world stuff that works. But it's still really tricky to get the right outcomes for people, even if you've got the best user journeys in the world. So there's a bit of a way to go still.
You started off actually by talking to us about the 4 pots in retirement, at retirement. Tell us a bit more about that.
Yeah, so we have a 4-pot model. We've had that for about 4 years. It's quite similar to what I think a few others are doing at the moment. So it's flexed and fixed effectively. So we have a income pot, which is where the majority of someone's money will go into. And then the idea is that our systems will then broadly draw that down until it's extinguished by age 80. Or age 85, you can kind of set it, but around 80 to 85.
Yeah.
And then the idea is we've got an annuity pot that then kicks in at that point, and people can buy annuities for that as well. And there's also a couple of other pots around inheritance, which we're looking at given changes to inheritance rules, and a rainy day pot as well if the dishwasher breaks. So we think it's closer to what people actually do and think about in terms of they want an income. And then we've effectively got the flexed and fixed income, but they want some savings around the edges of it so that it's not really secured into something that they can't touch or don't feel like they can touch.
How different are the assets that underpin those 4 buckets versus what you see in the accumulation strategy?
Some of it's quite similar because we don't want to completely shift investments on a single day effectively. So our income fund, we start to introduce quite heavily in our 8-year glide path. So that's the same. The inheritance pot, because it's much longer term, is the same as our growth funds. We still retain a bit of inheritance. What we might do is call that a kind of longer term savings or a care pot or something, because a lot of research we've seen is you need to put about 10% into your pot of retirement to fund care. So we might turn that pot into a care pot and have it as a long-term 20-year investment when you need it, when you're kind of 20, 30 years into retirement. And then the others are traditional kind of cash and annuity matching.
Okay. We can't have an investment conversation without talking about private markets. You've referenced it already, and as I mentioned earlier, you've made some exciting announcements. Where are you on your private asset journey? What have you got to today, and kind of what you're looking to do next?
I think we're pretty far advanced on this. We've had private credit for 4.5 years now.
Right.
So we're one of the first commercial master trusts that I'm aware of to move into private assets and private credit, and that's been a great story for us. It's held up really well during some testing times in private credit in particular. You may have seen an announcement we made around 15% we're putting. So that's into our flagship default. That's not an option that members have to choose or clients have to choose. It's within our flagship £5.5-ish billion growth fund that we have at the moment.
Right.
We expect that to grow to roughly 4 billion of private markets investments by 2030, given the scale we're achieving. That's going to be split between private credit, infrastructure equity, which we've announced with Octopus, which has just been a great journey. Those guys do some really wacky and interesting stuff, but the returns have been really solid to date. So
amazing.
We've started putting money into that, which is great. And then private equity as well, we're putting money into in the next couple of months as we build out that product. So we should be at 15% within the next 12 months, I think.
And what sort of vehicle are you using to access these? Are you using an LTAF, or are you going?
No, we're not using an LTAF. We're very close to pulling the trigger on an LTAF, but at the last minute thought, actually, let's reset and see if this is definitely what we want to do.
Yeah.
We don't inherently dislike LTAFs. We just think there's a few other fund structures that give us a bit more flexibility. And for us, the main thing they solved was permitted links.
Yeah.
But we moved to the Mobius Life platform about a year ago.
Right.
And they've been very pragmatic and flexible in terms of permitted links and what we can and can't do. I think over and above what we see with lots of insurance platforms. So it's one of the reasons why we chose them. So no, they're going to be various fund structures. We've got a Lux, special Lux partnership. We've got a SICAV RAFE in there. All sorts of different fund structures, but not LTAFs, no.
Interesting.
And is direct investment kind of on your radar? Are you thinking about that yet?
Yeah, we've obviously given it a lot of thought for a while now. Obviously, the kind of commercial aspects of it and the fee savings you can get from it, from the scale. What we found so far actually is that there's a lot of stuff that a platform does that gets taken for granted, and moving to a direct custodied approach actually introduces a lot of risk, a lot of operational complexity. Things like legal reviews of documents, blending funds, errors on NAVs, all the kind of boring stuff. Sorry, I don't know if I should say that about platforms, but for the man on the street, it probably is, but it's really important stuff.
The stuff under the bonnet.
The stuff under the bonnet, exactly. That's a much better way of phrasing it, is just so taken for granted in terms of how important it is and when it goes wrong. So we keep reviewing it, but I think we've got no plans at the moment to move to that model. We've got such great flexibility. We can do everything we want via a platform. And obviously, it works for us right now. So we're pretty happy.
Perfect.
And where are you guys in regards to the Mansion House Accord? Have you signed the Accord?
We have. Yeah, we signed it. We signed the compacts and then we signed the Accord. We're pretty bullish on it. We're doing a lot of it anyway. It was in our implementation plans in terms of private markets. So it was natural for us to sign it. I can see why some people have been a bit mixed about the Accord, particularly the UK aspect, because we're doing 5%. We're doing 15% into private markets, and 5% of that's going into the UK. So we're over and above the Accord, but we hit the UK amount.
Right.
Yeah. We're a bit more comfortable rather than it being 50% of our allocation to the UK.
Yeah.
And we're moving quite early on this stuff. So we think we can get in early on a lot of the opportunities in the UK. So we're having some really interesting discussions with venture firms in this space. And I mentioned Octopus. I think there is potentially going to be pipeline issues closer to the Accord date.
Yes.
That's going to cause some real market discrepancies and rush for assets that's not, if it's not fixed now, is going to be particularly unpleasant, I guess, if we will have to do the same thing. But for now, we're really happy with the place we are, the speed we're moving at, so it makes sense for us.
Interesting. At the moment, I guess we see private markets mostly in the growth phase of a member's journey. Do you see that changing? Do you see private markets having a role kind of later on in a glide path and into retirement?
We do, yeah. So we've got private credit in retirement in our income fund already, because it's quite a stable fund. It's great income, limited losses, touch wood to date. So we think that's quite a natural fund and asset class to have in retirement. We'll probably look at adding others. So the infrastructure makes sense as well, given the inflation linkage, given the kind of steady income and yield you get from it. Yeah. Things like VC and private equity is probably a little bit less of a natural fit into retirement, given the time periods involved in it, given the illiquidity, the esoteric risks you get with some of these sometimes. So that one's probably a little bit more on the tricky side. So we are looking at it, but more of the steadier income generating areas. But we'll also look at the liquid side of alternatives as well. So liquid alts, hedge funds, alternative risk premia, ABS, all that kind of interesting stuff that kind of mirrors a lot of the private market space. We'll look at that as well.
Exciting.
Just moving into another big investment topic in DC around sustainability. Where are you guys in relation to your sustainable process, your investment goals, any specific kind of commitments you've made?
Yeah, I mean, main one's obviously the net zero goal. So we're 2040 net zero goal, which is punchy. And we set that 2 or 3 years ago. So we're a long way there. We're already, I think we're about 60% from our 2019 in terms of carbon reduction. So we're a long way there on carbon footprinting wise. Obviously the hard work probably starts now to some extent, because there's the world is diverging slightly from net zero targets like we've got. And so finding opportunities becomes harder and harder, and we need to think about that. Yeah. There's a lot of thinking we're doing, and particularly Fiona, who leads our RI charge, is doing around sustainability and whether we as a company and we as an industry need a bit of a reset on some of these targets and initiatives, because they were probably set in a very different world. And for best intentions, we live in a different world right now. So there's probably a bit more thinking we need to do around sustainability and targets and how we think about those in a slightly different way. But yeah, I mean, everything we do is still impactful. We're not going to sway away. Well, we try and be impactful where we can, but we're not going to really sway away from that, because it's core to what we do. It's core to what our clients and members want. We think some of the recent kind of, I guess, challenges in the US, there's probably in some ways been helpful, because it probably reduces the real tip of the greenwashing kind of iceberg. So it's kind of helped calm some of that down. But generally, yeah, we're still remaining with our pretty firm focus on ESG and impact.
You play that through both the public side of your portfolio and the private side?
Yeah. So on the public side, we've got custom benchmarks, 2040 net zero benchmarks with SDG goals, exclusions that we've set. We've got split voting on them. And then obviously the kind of more impactful side comes through the private markets.
Fantastic.
Perfect. Are you looking at nature as an area, just out of interest? I feel like that's something that's talked about quite a lot at the moment, biodiversity, nature, investing.
We are looking at nature. I think generally we quite like to be fast followers when we think about investments. Let others kind of not make mistakes necessarily, but like experiment a little bit, and then we can kind of pick on some of the best strategies and funds. We think that's a good strategy. So there's obviously a lot of people innovating and doing and launching funds in this space.
Yeah,
I'm more of a personal view, I think, than a smart view, but we're being slightly hesitantly cautious on this sort of stuff. We think there's some really good opportunities in there. Through our private equity, we're going to get quite a lot of nature exposure through like the blue economy, bits of carbon capture here and there, but we just don't want to go too headfirst into things that are really reliant on carbon markets, for example. And things like forestry looks like an interesting area, but it's probably something we're just going to take a bit more time to let the thesis play out before we start putting money towards it. So it's on the agenda, but not something we're rushing into right now.
Makes sense.
So from a regulatory and policy perspective, obviously we've got big regulatory change happening, pensions bill being the big one. How is that impacting your investment thinking, strategy?
The short answer is not a huge amount, which is great because we're doing a lot of what the regulations, the direction of travel has been quite good for us. And actually, that's been really helpful in conversations we've had with government and ministers, because they can see that we're not at the 25 billion yet. We will be there, but they can see actually that the kind of mid-sized master trusts are doing everything they want to be. The government wants people to be doing anyway.
Yeah.
So we've had some great opportunities. You know, Andrew, our CEO, went to a heat pump factory and met the Chancellor, for example. Had some great photo opportunities there on that one. But we're doing all the stuff the government wants to do and the regulations are pushing towards anyway. So it's actually not really changing much for us. Obviously, the broader pensions bill, scale tests, etc., is in some ways has been helpful, in some ways unhelpful. You know, as a mid-sized master trust, we're obviously always going to get questions about where we're going to be, if we're going to be here for 2030, 2035. As I said, we'll already hit 10 billion next year, so we've already hit the 2030 figure. And we think with our growth, with the contributions, investments, and a couple of acquisitions we've got already on the books, we should be easily at the 25 billion scale figure as well. So we think we'll be kind of, you know, if there's 10 left, we'll be in the number 8 or the number 7 master trust in the market at that point.
And how are you guys thinking about the VFM framework? And you've obviously made some exciting changes to your investment program. How is that all fitting together?
Yeah, the VFM piece, we were involved in a pilot with the regulator on that one, which was interesting. There's quite a lot of data required for this and a lot of groundwork that needs to be laid for VFM.
Right.
So we're pleased to see a lot of the changes and nuances they've made to the kind of VFM framework around softening some of the kind of green, amber, red type stuff. We think that's probably a bit harsher than it needs to be. So they've softened that, which is quite helpful. Yeah, we're pretty positive on it. I think the whole market's been pushing in this direction for a while, and we're quite happy that it's pushing in this direction, as long as, you know, things aren't they work in the same direction and over the same timeframes, because there's a lot of investments we're making where we're going to be first in. From a kind of project perspective in infrastructure, for example, if we take some J-curve losses in the first couple of years, we don't want to be hit on VFM for that, for example. So yeah, as long as there's some pragmatism and some thinking around what the government's trying to do more broadly around private markets fits into it, we think we're pretty bullish on it.
Okay.
And how does all of the consolidation agenda kind of affect the way you invest, if at all? We've talked a little bit about this recently, and just like operationally, how do you find that whole consolidation lens affects what you do?
I don't think it really does, to be honest with you. Yeah, just because we've got because we tend to consolidate others. We've done 12 now consolidation. I think we've probably done the most in any master trust. We've got 2 on the go at the moment, worth about 1.4 billion coming in by the end of this year. it doesn't change because we're full steam ahead in terms of reaching scale targets. Our investors are here for the longer term. So there's not really much we do differently. And that's why we've had the support of our trustees and leadership teams to just kind of put money into these quite exciting, innovative asset classes that are longer term investments. So not really much change. We see it a lot when we're buying companies. That's going to be interesting, I think, for people that are consolidating over the next few years. We've already run up against some interesting investments that people have made in the past that we have to unwind and put into our funds. So when we've got no plans to run multiple schemes and take 3 or 4 schemes and run them separately, because that doesn't make any sense for anyone. But that means a lot of hard work to get investments wound down. So that's with private markets and long-term commitments that people are making, that's only going to become more interesting, I think, over the next few years. So yeah, it's an interesting one.
So turning our lens to a bit of future gazing now, for you, what's next on the investment agenda?
Luckily, if you'd asked me this a year ago, I would have said kind of the whole world and their dog. But at the moment, it's quite nice to be in implementation phase of a lot of this stuff. We've done a lot of our work and hard thinking early compared to maybe, what the kind of themes in the market are. So implementing private markets, a little bit of looking at some satellite allocations here and there around, as I say, natural capital and real estate, a couple of asset classes on our agenda, maybe some of the more liquid hedge fund alternative space. But really for us, we're 99% there and happy with our portfolio. So it's implementation, it's getting the right governance around it, it's talking to members about everything we're doing, obviously continuing to win new business and scale up. So luckily, investments wise, we've done a lot and we're not going to be doing too much more in the next year or two, we think.
I guess, like you say, you're one of the early investors in private assets. To have a 4+ year track record of private credit puts you in an interesting position where you can actually continue to see how that's working, how it's evolving, and how, for the first time, putting illiquidity into an inherently more liquid kind of product is working. So it must be interesting to see that evolve, and you can continually learning.
Yeah, I mean, that product in itself has evolved over the past 4 years. We've just we're looking at kind of reshaping it a bit to focus on a bit more impact lending debt. So we're working with our manager, Clearlake, on that one. So yeah, it's great to have the foundation to really change and adapt these funds over time.
Interesting.
So 2 more crystal ball gazing questions. What is one investment trend or technology you think will reshape DC over the next 5 years?
I think one area that we've been looking at, and that's quite interesting, and a few others are looking at, is tokenisation. We this is probably early doors, and I can't release too much because we're doing some interesting projects on it at the moment. But we think the whole, people run a million miles away from crypto, but I think what they're running away from is Bitcoin and the whole ecosystem around some of that. Sometimes we think there's some phenomenal technologies out there to really reshape investment management and pension funds and how we trade assets, how we can fractionalize assets. There could be private markets investments that people can own fractions of shares on. We can start building new ways of selling them, getting liquidity for them, valuing them, working with completely different asset owners than the traditional ones that we work with. And also it really brings a quite interesting member aspect into it as well. So yeah, it's early stages, but tokenization, I think, is going to be pretty big. Obviously, there's lots of cash funds and money market funds that have been tokenized. We think that's the tip of the iceberg, and we're hoping to be on the kind of ship as that one kind of steams off.
That is some exciting future gazing. Similarly, what in your view is an underrated investment asset class? Something you might be invested in already that you think is just underrated, or something you're looking at?
I actually think the use of kind of derivatives and structured equities is underrated, and people have some concerns with, but I think they're probably largely unfounded when they get underneath the bonnet of it. And I think it's worked for decades in DB schemes and LGPS schemes. And I think it needs to come into DC in some form in a bit more way. But I think as we, as an industry, professionalize even more, get more assets, more growth, deeper trustee boards, deeper resourcing, deeper expertise, and a lot of that comes from DB, I think it's going to be a lot more prevalent than it is right now. But I think it's a really interesting way of accessing exposures and also opening up fee budgets elsewhere in DC land to do a lot of the stuff that we talk about. So I think, derivatives and that kind of whole space is very underrated right now.
James, thank you so much. That was such an interesting conversation. I feel like I've learned a lot about where you are. So thank you for coming along.
Thank you. Thanks for having me. Cheers.
Thank you for listening to Changing World, New Opportunities, the DCIF's podcast.
Visit us online at dcif.co.uk, where you can read all our research, follow us on LinkedIn, and subscribe to the show.